Alrighty, check, radio check. I want to welcome everybody to Chat with Chris, weekly Chat with Chris here on Thursday, May 25th. If you've not been on this call before or unfamiliar, typically since COVID had hit, I started doing a weekly Chat with Chris. And what's the concept was, bringing financial topics, myriad of topics each and every week, my schedule allowing. Once a month, what I try and do is what I've deemed a Monday day quarterback approach. So, May, when you see May 2023, it's not for the month we are in now. It's really a snapshot of the markets for the last month, so the month of April. So we try and be pretty consistent and show this up. So the data that we're going to talk about is really a rear view mirror instead of what do we see on the news today, right? Because if you watch the news today, quite often the sky is falling or it's raining, gold, right? It's either the pendulum is either so far left that it's gloom and doom, or it's so far right you can't possibly miss the mark. So what we find is that, really to start to try and take the emotion out of planning for retirement, for a myriad of topics, taking this approach allows us to sort of, take a sort of a higher level view of what happened. And let's interpret that. And what do we see? Now, that doesn't mean that what we saw last month is now maybe no longer applicable, but that's the concept. So without further ado, we're going to go forward and I'll sprinkle in some tidbits along the way. So the equities section, right, is done in two parts. There's a month of April, and these are color coded. And in the middle here, right here, is the 0% line. And for those, again, just a recap, we use Y charts here. So we've changed the color coding. Line green here is Europe. Gold here is the Dow, right? And then you have this purple here is the S&P. Then you have green, which is real estate. Hot pink is emerging markets, so I typically call that China. And then you have commodities, and lastly, we have small caps here. But this is a one month snippet. And now when I click to the next slide, we'll say, well, okay, are we on track? And this is why I said you can see that there's variance here, right? That things go up, they go down, especially let's look at commodities. Commodities started off pretty high for the month, but then they bottomed out and finished up negative. And so things change, whether that be oil or whether it be precious metals or anything like that can cause a knee jerk or a blip, much like on an EKG. But when we take a little bit broader scope, a 1 year viewpoint, right, we will see that, okay, now it does start to smooth a little bit. Now, commodities have continued to be challenged, right? Even though they got a little bit of a reprieve earlier in the month, they tended to gravitate back down. They're under pressure. But, Europe seems to be winning the race right now so far year to date. And then followed by the S&P. So you have, the S&P 500, European nations. So the economies of these, two global governmental entities, right? Because it's not just, say, England, it's also France. It's developed countries in Europe, and then the US are looking positive, right? Right now, year to date, you can say, hey, actually things are okay. And it probably equates to your 401k statements or your investment statements. As we get a little bit lower, we can see, for all in all, for as much noise that has been out there, and this is why, we have said there are some recession, indicators out there, things to just have a heads up about. But you could, sitting back playing Monday quarterback, go, you know what? Your portfolios really didn't vary that much. And, so what's that mean for the future? I just say that right now, this is why, the talking heads, and when you watch, some of the networks, they have to tap into those emotions. And that's what sells news. Something is going on. Something is hot off the press. Something invariably can cause markets to fluctuate. So when you're dealing with you personally, your investments, your planning, your future, we're not robots. So we have to start to have a strategy looking and going into the future that helps us to, as best as we can, remove some of those emotions so that we can go into it. Yes, we know things can go up. Yes, we know things can go down. But what can we do to smooth that curve or maybe diversify amongst several different types of asset classes to smooth some of the volatility that we see? So overall, I would just say I think the graph speaks 1,000 words, that things look okay up until the end of April. And then, the three wise men, or the triple cross, we don't see a green line yet. I would say that the MACD at the bottom, that's this moving average convergence divergence indicator. This crosses over. And this one here is close. So maybe in May, June, we might see that, but barring any negative news. So overall, we still are cautious because of some headwinds that we see in the economy. But as you saw on a macro level for the charts, your portfolios have probably remained pretty, even. So that's good news compared to the alternative. So now we're going to look at income portfolios. So again, once again, as we look at 1 month, we're going to turn around and say, the blues here, this is treasuries. So I'm going to get into this on the other chart, but the short-term treasuries is typically a flight that consumers and institutional investors will move to when they're concerned about the future of the economy. So it's sort of like an indicator that can say, hey, we're concerned that there's uncertainty in the future. So that's probably why you saw such returns, is because people were gravitating there, and that drives up the price. But then the rest of these, the purples, US aggregate bonds, overall positive month. You had the negative, which is the muni bonds, national muni bonds, but overall not horrible. But when we look at the macro for the year, everything seems to be up. And again, now we look at the 20-year treasury, and this is leading the pack. And so between the top two, the hot pink and the powder blue, we can see that at least my interpretation of what I'm looking here is this still in the month of April, there was a flight to safety. And that makes sense, because when you think about it, what was going on, and now that's right about the time the debt ceiling conversations started to happen. And people are concerned, they're looking for, safe places to go. But now you may see a flight, right, from some of these, because people are concerned what happens if the US defaults on its debt. So I'm going to bring up the next chart, and then I'm going to read a little piece from our CFA that he put out that I thought really explains some things, because people do have questions about our debt. But right now, again, I think that this bottom MACD has a crossover, so that's a positive sign, could turn this vertical red line green. But this crossed over, so the 90-day moving average has not happened. And here we're in the middle of the pack here. So right now, there's not a buy signal or an upward trend on the portfolios. But if you're at work, you have 401ks, and this is not investment advice, but it's just if I was sitting here and you were in my office, I might suggest, hey, listen, where before I've been cautious with bonds on a go forward, I am now comfortable entering into those on a dollar cost averaging perspective. Now, I'm just going to read this because, the debt ceiling, Mark wrote this and I thought it was good. So the Treasury runs the government's checkbook and is responsible for meeting the government's obligations. If there is not enough cash in the general account to fund the expenditures, the U.S. Treasury sells bonds, treasuries, to raise the necessary funds. The debt is the accumulation of the government running annual deficits. Basically, spending is greater than receipts. He goes on to say, however, Congress puts a limit on the amount of debt that the Treasury can issue before it has to get congressional approval to issue more debt. It is important to point out that the debt ceiling is not about new spending. It is about paying for what policymakers have already agreed upon. Currently, the spending breaks down into approximately 63% mandatory spending, 7% interest on treasuries, and 30% discretionary. So I thought that was a good point because my personal opinion, I had a phone call from a client this week that used to be for the federal government, has since retired, and is working for state. And, he's been getting questions at work. Chris, what happens if the government defaults? Now, it's never happened. However, could it? I think we're closer now than we've been in the past. However, all signs point to some type of compromise. So if for whatever reason, and this is again just my opinion, if for whatever reason a deal could not be reached, right? The sky is not falling. It would downgrade the US's strength as our currency being, one of the leading countries in, finances on a go forward. And that's never good. It's just like your own personal credit rating, right? When that gets under pressure, it makes it harder for people. A, it's more expensive to borrow, and B, people are less likely to lend to you, right? So those are the concerns. Now, what does that mean for people that are getting Social Security, retirement? Those are the promises that the current debt ceiling, raising that, is really addressing, is making sure that the promises that have already been made get met. So, this is not about a political message, and a lot of times this stuff gets politicized. This is just really economics. And at the end of the day, it seems likely that I think both sides have to compromise and come to an agreement that is, on a go forward, allows America to continue to try and settle their differences regardless of the aisle. So that's my impression. Hopefully that made sense. If it doesn't, give me a call. But if it did default, there could be a delay in paychecks. People that are getting money from the government, whether you're employed or on some type of Social Security or things like that, it's never happened before. So this is speculation on my part, but everything that I'm reading is saying, hey, listen, it could delay until they catch up and get it fixed. So just, I guess that's my way of saying, hey, listen, relax. It's going to work out. Turn off the TV and stop listening to the news. Just enjoy the people that are in your lives. Watch your bank accounts, make sure that they're FDIC insured, make sure that you're investing in things that are regulated and not speculative, and things will be okay. If you have questions, if we can help, please let us know. So the other thing is that the recession probability analytic tool that Brookstone offers uses 100 data points, and it's down from the month before, which was at 84. So again, it's still above 50. 50 is the baseline, and it says, are we heading towards a recession, right? And, for 2 years, we were basically saying, hey, be careful. We're now on the other side of it. So that just tells me that there's pressure on a lot of different sectors, but, inflation is down, right? So some of the things that the Fed is doing, raising interest rates, even though people are getting laid off, right now, but I do hear that they're able to secure a job elsewhere. So we're still in this gray area of uncertainty. So again, it's not gloom and doom. The sky's not falling, but we have to, take a measured approach on, cash is king, making sure that we have access to it, that we're not, being risky with any of our, ideas, investments, purchases on a go forward. And if you need some guidance, that's what we do here. Lastly, have a wonderful, wonderful weekend. Right. So hopefully, I'm working tomorrow. So it'll be a blended light holiday Friday and then, 3 days off. So enjoy some barbecue, hug the ones you're with. If you need me, please reach out. And then here's our disclosures. Everybody have a great weekend.